and welcome to Money Control. We continue our conversation series on how to navigate 2025 with market veterans, bringing you 5 big ideas, trends, themes and stocks to help you protect your portfolios from potential cuts while also keeping them positioned for growth. Joining me today is Sanjeev Prasad of Kotak Institutional Equities, one of the most respected voices in the Indian equity research scene. Thank you so much, Sanjeev, for joining me today. Since we are meeting for the first time this year, Sanjeev, wish you a very, very happy new year.
Happy New Year to you. Thank you.
So, Sanjeev, for a good part of last year, you've been cautioning against irrational exuberance in the market, so to speak. And you continue to do so. Even in this year's strategy report, you say that, you're quite not even circumspect, you're quite bearish. Please explain to us what is your worry really, although it's clear in your reports, but for the benefit of the audience, please lay down your thought process.
Sure. Okay, so number one issue is the fact that valuations are still very, very high, pretty much for most parts of the market. If you look at the large caps, beyond the banks and a few names here and there, if you compare the multiples with historical levels, let's say before the pandemic, in most cases, multiples are similar or higher. And this is true across sectors, whether it is the consumption sectors, large cap, mid cap, whether it is investment sectors, the capital goods, EMS, etc. Again, large cap, mid cap doesn't matter. And similarly, outsourcing sectors, multiples are actually significantly higher than the pre-pandemic levels, whether it is IT, pharmaceuticals. So that's the first issue. Multiples are very high. Number two is the fact that multiples are high at a time when growth seems to be a lot lower, both in the short term, and also I have some concerns around growth across sectors, or I should say most sectors in the medium term too, which we can discuss separately. Yep. And number three, the fact that if you look at the global setup, it is not looking very good. Global bond yields are very high. They have gone up significantly in the last 3 months or so, around worries about inflation not really coming off at a desired pace, and there could be some negative surprise inflation too, linked to the policies of the new US administration. And obviously, there's a lot of uncertainty around many other issues, starting with trade, tariff, immigration, healthcare, and so on and so forth. So in this environment, it's just very difficult to get excited about a market where valuations are, full to frothy in most cases. You are seeing some challenges in growth in parts of the Indian economy, particularly on the consumption side, and possibly could see earning downward as we go forward. And you do not have a very supportive global macro situation, I would say. And we can delve into all these three aspects in more detail as we go along.
So let's break this down. The number one thing is the mid-cap madness, which you've been talking about for at least 6 months now, as far as I can recollect. Can you lay out where exactly do you still see a lot of madness? Because since the middle of last year, a lot of stocks have already corrected more than 30%. I mean, the defense space, the railways, and a lot of stocks have corrected more than 30%. Even now, you think stocks are overvalued?
Yes, unfortunately. So if you look
and
at
within the
sector by sector,
mid-cap space?
Yeah. So if you go again sector
if
by
you can
sector,
just lay this whole mid-cap space sector by sector.
Sure. So let's start with the consumption sectors. If you look at some of the smaller consumer staple names or some of the discretionary names or the QSR companies, the multiples are super high over here, and you are seeing serious challenges on growth pretty much across the board, I would say, barring a few exceptions on ACs, etc. You are seeing significant slowdown and volume growth pretty much across categories, subcategories of the consumer basket. And it's linked to the fact that it doesn't look like we are seeing a lot of income growth at the low to middle income household segment, I would say. And there are clearly affordability issues given the fact that product prices have gone up significantly in the last 4 or 5 years. Income growth has not been that robust for at least that section of the households. Yeah, so the affordability is not looking very, very good, I would say. So that's one. Then you come to the investment sectors. Again, the smaller capital good companies, your EMS companies, etc. Again, valuations are very, very high. Here we are seeing decent earnings growth, I would say, and some confidence with respect to top line and bottom line growth. But given the business models of these companies, I'm just struggling to, to to digest 75 to 100 P multiples in many cases. Hopefully, the top line momentum continues, and the earnings grow into the valuations over a period of time. But I can't see it, or at least I can't make a case for multiples getting related further from where we are. I think earnings have to grow further, to justify the kind of multiples these companies are trading at. And then you look at the outsourcing names, which is IT and pharmaceuticals. Look at the IT names, tier 2 names in particular. In most cases, multiples are now north of 40p. You had much higher growth rates for the tier 2 companies compared to tier 1 companies, especially anything which was linked to the ER&D space. The market has got, I think, too carried away, and the market extrapolating the growth which you have seen in 21 to 24 period all the way, for the next several years. The problem is the auto upgrade cycle looks like coming to an end. Auto OEMs are facing serious challenges, as you would have been reading in the press. So I really doubt, that you will see a big acceleration in auto spending by the auto OEMs as we go along. If anything, there would be probably a decline in spending over the next 1-2 years. And companies are actually postponing the transition to EVs from ICE, etc. So I think there could be a big negative surprise with respect to the kind of top line growth these companies have been reporting, and that kind of top line growth that the investors have come to expect from these companies. You would see a big deceleration in revenues as we go along, and multiples are still very, very high, 40, 60 P kind of a situation out here. If you look at the pharmaceutical names, I mean, some of them are also fairly domestic oriented. There you have seen a massive rating in the multiples. Again, most of the domestic pharmaceutical companies are trading, north of 30p now. In some cases even 45, 46p, which is just hard to digest. To be honest with you, yes, these are good companies, have a long runway of growth, etc. But with a top line growth of let's say high single digit, low double digit, in most cases, it just becomes a little bit of a stretch to justify this kind of valuations. If you look at the healthcare services space, hospitals, diagnostics, again, fantastic set of companies, but again, valuations are just very, very high. So I think, we could possibly see two ways this situation resolves itself, right? One is, of course, a price correction, which we have seen in several cases, particularly I would say the weaker quality names. But valuations have not come to any comfortable level. Many of the stocks are still supremely overvalued even now. And maybe in the good quality companies, maybe you see a period of time correction, or earnings grow into the valuations, and maybe that's how the situation resolve itself. Right? You see, again, a lot of this will depend on how foreign investors behave, how retail investors behave, and so on and so forth in terms of how patient they are.
Sure. So let me take one or two aspects that you talked about. One, if we just divide this into low growth companies versus high growth companies, high growth companies are also the narrative companies. And there you say, and correct me if I'm wrong, in many of these companies, you've not really seen any significant deceleration in growth. They continue to at least show either good order books or the top line is growing. But as you correctly point out, for most of them, even the PSU basket, non-banks, you see most of them are trading at more than, 10 times sales or even upwards. Are you suggesting that there is a possibility that they will track earnings from here on, or you think there will be a serious correction from what we have already seen?
If you look at some of the PSU within quotes, narrative stocks, I just struggle with them, to be honest with you. These stocks have gone up a lot. Now, whether it makes any sense or not in the context of the business fundamentals, at least I am unable to fathom the kind of, market cap many of these companies are trading at. I mean, you look at something like, for the sake of taking a couple of names, Hindustan Copper. I mean, the stock is trading at, if I remember correctly, some 70p, by the way. It's a copper company. Profits have not grown over 23, 24. So, I just don't understand why a metal company should be trading at 70p. It should logically be trading, 10, 12p, which is where some of the large cap metal companies are trading at, right? So similarly, you have, again, an RFC as an example. This is a company which has got 1.8 trillion rupees market cap, $20 billion plus market cap, trading at almost 4 times price to book, and it's just a financing arm of the Indian Railways. You have many of the larger PSU banks which are trading at 0.6, 0.7 times price to book, with a very large retail, loan book on top of that, and of course a very solid deposit base. So there's just so much disconnect between valuations. When you see some of the stocks, you just struggle to understand what exactly is going on in these names. And I can give you enough number of examples. Now, even if you look at some of the narrative sectors which have come and gone, I mean, the biggest narrative last year was, for example, this whole electricity, shortage. On the back of that, a lot of, coal-based generation capacity being set up and whatnot, so everybody got carried away. A lot of the coal-based companies, including Coal India, the BTG company like a BHEL, the NTPC, all went up on this theme. But suddenly nobody's talking about electricity shortage in the country. What happened? There is enough amount of, solar electricity generation capacity being set up. And in a way, India is also addressing the problem of supply during peak time by now giving bids for composite electricity and storage, projects. Yeah. And so suddenly the electricity deficit, which everybody is talking about, is not looking that large, which suddenly means that we don't need that many coal-based thermal power plants. Looks like, unless until the power demand picks up in a big way, and we again start seeing serious amounts of shortages and so on and so forth. So that is one problem, over here. In India, we have way too many narratives which come and go. People get excited about them without, doing a lot more work into it, whether that's actually true, not true. Over time, many of the narratives, get proven wrong. Actually, that's what I've seen. And there are a few more narratives I can talk about later on.
So the larger point you're making is that we are seriously exaggerating growth, because that is how these narratives get formed. And that's all got priced in. And like in the case of power, you're seeing demand contraction or no pickup in demand, and that's not something that the market is recognizing yet.
Well, demand is fine. It is, if you look at I think the first 9 months demand, power demand is about 5% up. If you take any CAGR in India over any period of time, last 10 years, it's always been a range of 5% plus minus. There'll be some years where you will see a big increase, but it's not growing 5%. You can see ultimately there is something called improvement in energy efficiency. All your electricity equipment every year will become more and more energy efficient, right? So even if real GDP is growing at, let's say, 6%, your electricity demand cannot grow, much beyond that, right? And if you build in the energy equation part, then it is lower than that. But, anyway, people get carried away with narratives from time to time. And that's unfortunate, I guess.
No, but this is also predicated on two big things as far as what I'm reading. I mean, two big changes. One is, the change in composition of a GDP with manufacturing, taking us, going a step up. And the second thing is the data center demand for energy, which is also can grow exponentially, especially if we were to sort of go down that route. Doesn't that alter the equation considerably, and would the past be really a benchmark? Can we assume a 5% growth from here on?
We'll have to wait and see. We are not seeing any great pickup in manufacturing in India, to be honest with you, right? You know, yes, there is some progress on some of the PLI linked sectors, but it's not as if we are putting up, massive amounts of new manufacturing capacities or new infrastructure sectors, etc., which will consume a lot of power. I mean, data centers, it's all good and nice, but they are not going to be consuming huge amounts of power anyway. And honestly, data centers can be run on a combination of solar electricity and uh, and um, and battery storage. See, I'm not making a case that electricity demand will not grow. It will grow, and I hope it grows faster than what we have seen in the past. But there is no case for it as of now. I mean, the limited point I'm making is that the kind of you know demand growth which was being talked about, power shortage which was being talked about, that's not the case really. Because solutions emerge. Suddenly, we are seeing in India. You look at the cost of solar electricity generation, 3.5 rupees, significantly lower than thermal for now. Even if you look at the cost of or the tariff for solar electricity generation plus storage, that is 4.5 to 5 rupees now. It's comparable with thermal. So technology solutions always emerge to meet any let's say a perceived uh, deficit or shortage or anything like that. And we are seeing that, there's huge amount of interest in solar electricity generation. A lot of capacities are being built up. So I'm not making a case against electricity growth. I'm making a case against the fact that this whole narrative which had got built that India would need huge amounts of coal-based thermal capacity, that is no
Yeah.
longer true, I would say.
Right. Fair enough. And what about the low growth sectors? Is there a problem in consumption which you think is not going to get, it's not a 1 quarter, 2 quarter issue, but it'll take longer for it to get resolved?
I'm not worried over here, to be honest with you, because until a year back, I was in the camp that this is a cyclical factor linked to a combination of, very tepid post-COVID recovery in, let's say, the lower 50% income households, and also very stiff price increases taken by companies during, I would say, FY22 and FY22, 2023. You look at the level of price increases taken by companies, it's like quite high, I mean, between 40 to 70% if I look at some of the staple products, yeah, over a 2 year time frame. So I was more in the camp that, look, you have a period of, low income growth for the low income households. Plus, you have very high price increases, and companies were forced to take price increases because of, rapid increase in raw material prices and so on and so forth. And because of that, the whole affordability situation has become very warped against the low income households. And my view was that in FY 2024, you will start seeing or rather FY 2025, you will start seeing some recovery in consumption demand on the back of stable product prices and continued recovery in income. Unfortunately, that's not played out. And I'm getting a bit concerned that some of these factors could actually be structural and not so much a cyclical. And what I mean by that is, if you look at the whole job situation in India, on paper, we are creating huge number of jobs. But the quality of jobs remains a big challenge. I mean, just to give you some data point, this is based on government's own data, periodic labor force survey. The positive news is the labor force participation rate in India has gone up dramatically based on the last 6 labor force surveys which the government has put out, from roughly about 37% in around, let's say, June, middle of 2018 to somewhere about 45% now. So that's a great side. A lot of it has been driven by women workers, where the labor force participation rate has gone up from about 18% to 32%. So all great news there. But the problem is a large section of the incremental workforce
Right.
seems to be joining agriculture in rural India, which is the new women workforce, or joining the gig economy in urban India. And some of the data which we extrapolated based on, again, the government survey, I mean, take this with a pinch of salt because it's based on survey, so it can be a little bit here and there. So on paper, India created about 140 million jobs between 2018 and 2024. Fantastic. That's massive. But the problem is, it looks like out of that 140 million jobs, 80 million jobs were created in rural India, and about 64 were created for women workers in agriculture. So, which means about 45% of all the incremental jobs in the country are basically new women workers in agriculture. Obviously, incomes are not going to be very high over there. So that is where we are. What we need is more jobs to be created in low-tech manufacturing, low-end services, where some of the low-skilled, low-educated workforce can get employed rather than being in agriculture. So I'm just laying down the challenges. Hopefully, solution will emerge because ultimately, we are a nation of entrepreneurs. And then, given the right amount of thrust on this employment issue, I'm hopeful that some of these challenges will get resolved. As many other countries did, like China is the same story, right? You have people migrating from rural parts of China, women workers moving to
Right.
manufacturing centers on the eastern seaboard, and it was facilitated by the private sector and the
Right.
government. Safe working environment created for women. You had massive migration, from very low value add activity in agriculture to much higher value add activity in low tech manufacturing.
Right. So, in which case, do you think the premiumization theme, which has sort of been the dominant theme in the consumer space over the last three years or so, you think that will continue, or is there a bubble getting formed there also?
The theme depends on the pace of migration of people from lower income households to lower middle, from lower middle to middle, and so on and so forth. It's all about upward mobility of households and income growth, right? Unfortunately, we haven't seen that to that extent for two reasons. One is just the fact which I explained. You haven't seen that much growth in income of low income households. And the second problem is price increases have also been very rapid. So unfortunately, the whole premiumization story has got delayed, I would say. So what we need is a period of stable product prices and fast growth in income for the low to middle income households. That can drive premiumization as affordability, improves over time. Here, so we are running, just to stay in the same place, right? If product prices are rising very fast, incomes are not growing, you are actually seeing a downgrading going on, which is unfortunately what happened in FY23 and 24, when it looks like people had to downgrade
Right.
to products from the online sector and so on and so forth. See, the challenge now is even now the raw material prices have gone
Right.
up very high, especially if you look at the agri inputs, whether it is palm oil, oils, etc. Over the last 6 months, 12 months, we have seen massive increases in raw material prices. Unless until they come off in a big way, companies will be forced to take prices, take up prices, which means the
Right.
affordability situation becomes worse, at least in the short term, before it gets better. So I think premiumization theme is becoming questionable, at least in the short term. It will entirely depend on how quickly incomes can grow over a period of time. And unfortunately, in last 4 5 years, and maybe in the next year also, I think we are going to see some headwinds over there.
Right. Right. So now winding back to another big question I want to ask you is, all of this about overvaluation, what you say is quite convincing. But the issue is that you've seen this buy on dip approach through and through. Even with a 10% market correction, I mean, there is such huge resistance for stock prices to go down. How do you see that reversing? And do you see that reversing this year?
Just let me lay down some facts over here, which explains why this buy on dip mentality is there. So first of all, if you look at the retail participation in the domestic market has gone up tremendously, right? And a lot of data available to prove this point. If you look at the most important data point is like if you look at the number of domestic mutual fund investors, equity mutual fund investors, that used to be about 23 million as of March 2021. That number as of September 2024 has become about 50 million. So that means, more than half of the investors in domestic equity mutual funds are new to the market. I mean, within quotes, because they may have been investing directly for all, but let's assume, that many of them are in a way new to the market. Now, the experience has been great over the last 3.5, 4 years. Many of these new investors have come to the market, either directly or through the mutual fund route. The market has done very well, despite the recent correction. So the general feeling which has got built in the retail community is that number one, you will always make money in the market. Number two, you will make large amounts of money in the market. And number three, you will make even larger amounts of money in the mid cap and small cap space. I mean, nothing wrong with that because that's what many of the investors have experienced in the last 3-4 years. Yeah. But obviously, this argument is only valid up to a point, right? Because it's not as if we can be making money at all price points. At some level, this will break down. Now, whether we are there, not there, I don't know. But at least in the last 6 months, we have seen a decent correction in many of the large cap, mid cap, small caps. Even the indices are down about 19% now, if you look at from the peak levels. Yeah. So the question is now whether you are seeing any change in the retail investment philosophy, which was buy at all price points, including buy at dips, and this has worked wonderfully well, at least for the last 3 years until let's say recently. The problem with this philosophy is, that this is a price agnostic buying behavior basically. Yeah. People are buying irrespective of price levels, which means they're buying irrespective of valuations. And that is where the challenge comes in. So up to a point, as I said, it is valid. But beyond a level, I mean, you can't be giving 50, 60, 70, 80p for any random company, right? And that's unfortunately where we have reached. Many companies are trading at completely absurd valuations. So the math has to break down at some level. Now, investors are still very bullish based on experience last 3 years, notwithstanding whatever they have seen in the last 6 months or so. So this may very well continue, which is maybe what we are seeing. If you look at the December month, you had a significant amount of money going into the domestic equity mutual fund, for about 40,000 crores or so. Yeah. So as of now, there is no let-up. Now, how does the situation resolve itself? Either this continues, which means, you see there's absurd levels of valuations in parts of the market, sustaining for a long period of time. Or let's say the next 3, 6, 9 months, the market, sort of doesn't go anywhere, which means some investors at least start questioning this logic, this investment philosophy that you will make money at all price points, etc., right? Because suddenly the 12-month trailing returns will not look very good. In some cases, it will start looking negative for the people who have more recent vintage who have come in the last 6-9 months. And then there will be some review of this basic investment philosophy, right? Or God forbid, if we have a bigger correction, which is the third scenario in the market, then all bets are off, because then suddenly a lot more seeds of doubt will be sown in the minds of retail investors, whether they should be even looking at equity markets. And unfortunately, there could be panic at lower levels. Yeah. I mean, I'm not saying anything like that will happen, but I'm just laying out the 3 possible scenarios out here. So let's see, how the situation resolves
and
itself.
And what would you say
all
is the
3
most...
possibilities. Yeah. Mahalakshmi, to be
what
honest
is the
with
more
you,
likely scenario, that the markets will flatline?
You see, I don't know, to be honest with you. I don't forecast stock prices. All I try to figure out is what is the value of a stock and whether it makes sense related to the price of the stock or not. Unfortunately, most investors in India started taking cues from prices, not from value. So my investment philosophy is very different. If I see the price is significantly higher than the value, I have no interest in the stock. If the price is significantly lower than the value, with huge amount of margin of safety, then I'm interested in the stock. Otherwise, why take unnecessary risk? Yeah. So I don't know which way the situation goes. The issue is now, if we see a big correction in the market, let's say 10-15% correction, we reach some equilibrium level whereby the foreign investors stop selling, then I think we're done in that case, right? Then life goes on. Retail equity investors, fine, they may have lost some money, but from whatever, let's say a lower level, maybe there's money to be made. When you keep investing in the market for medium to long term, you're fine in that case, right? But the second situation is, the foreigners continue to sell, and the domestic investors, that is retail investors through the mutual fund route or through directly, continue to buy. In which case, we are giving exit to the foreign investors, by the way. I mean, right or wrong, I don't know. I'm not getting to nationalism issues over here, but that's what it turns out, right? It's basically a fight between FPIs and the DIIs. When I say DIIs, it's largely retail investors, right? And in a way, you're giving investors to, at least in my view, foreign investors, exit to foreign investors are still very high levels, by the way.
Okay, now coming to the point that you talked about, that, your job is really to look at the value of the stock. Blue chips, and Ramdev Agarwal coined this term called Bruised blue chips. recently in his wealth creation study. And I saw your, table on, valuations in 2019 versus now, forward estimates of Kotak. And there are definitely 5 or 6 stocks which are quoting today at valuations lower than 2019. HDFC Bank, Bajaj Finance, Asian Paints, Avenue Supermart, even Maruti. What's your take on these companies? Is there something changing fundamentally that could justify the valuations and should prevent us from comparing it against historic valuations, or are these value buys?
Before I get into the specific companies, one of the things I would sort of caution people against looking at this historical multiples, too much, because the multiples are valued in a certain context, so what multiples were the correct multiples, let's say in the last decade, need not be the correct multiples for the next decade or for the future, yeah. And I'll give you a few examples. What if you look at the consumer staples, or Asian Paints, yeah. Either the macro environment for the sector has changed dramatically. If you look at the paint industry in the 2000 to 2020 decade, those 2 decades, it was a very fast-growing sector. You had 4 players at max, very nice market structure, etc. Now you come to 2024, 2025, you have the growth has slowed down dramatically, but maybe that's a cyclical problem. Hopefully the growth will come back, yeah. And we'll go back to the same growth rates, or hopefully even higher, whatever we have seen in the past, yeah. But the second problem is the fact that this market structure is no longer as good from a company's perspective. You have many more players now. So suddenly from a 4-player market, it's become a 7+ player market. The bigger issue is, in the last 2 decades, Indian companies have enjoyed tremendous profitability based and returns based on the very nice market structure they operated in. Across sectors, starting with the paint sector as a good example, market structures are worsening. You are seeing more fragmentation, more competition, etc., etc. So how do you apply the same multiple, forget about the cost of equity argument for the time being, for a sector where growth rate could possibly be lower? Anyway, keep that aside. But the volume, whatever we see in the future, is going to get split across more number of players. So let's say paint 7 versus 4, yeah. And more important, the profitability/returns could be lower. And that is my fundamental issue with the kind of multiples investors are willing to give to stocks currently. Nobody looking at the change which is happening to business models of companies, the kind of changes, disruption risks which are emerging across sectors. Everybody is just looking at the last 5 years multiples. Oh, this traded at 50p, so 50p is fine. I mean, it doesn't. I wish life was so simple, It doesn't work like that. The whole context has changed.
Right.
In many cases, you have seen serious disruption risk, serious technology risk coming. So, for example, coal-based thermal generation. Who knows what the future of it in 10 or 20 years down the line? So how do you give the same multiple as what you were giving in the past? So that is one big problem in the way the market is approaching valuation versus at least how I am looking at it, and which is where some of the disconnect is probably coming in our slightly more cautious view versus whatever the market is looking at. Coming to the specific sectors, company which you talked about, see, it's the same problem everywhere. HDFC Bank was working environment where public sector banks were impaired, right? So until recently, you only had 5-7, handful of private banks and NBFCs which were doing very well. The entire last decade, for example, especially the second half of last decade, 2015 to 2020, PSU banks were under serious facing serious challenges on the NPL part. Even the private banks like Axis, ICICI were facing a lot of issues, right? So you had this, in a way, a two-tier lending market. One set of banks and NBFCs expected to grow fast with no NPL issues, and the rest of the banks and NBFCs which nobody was even willing to look at. I remember in 2016-17 when we first started making the case for ICICI Bank, no investor would care either way get lost. Now everybody is in the extreme, that's other camp, right? So HDFC has gone through its own, derating in a way, because can these growth
Yeah.
rates go back to what we have seen in the past? Very difficult, given the fact that I mean, you have other banks, NBFC is doing equally well. Um, can NIMs hold up in that environment? Difficult. So, so obviously the multiples have to compress, compared to whatever we are given in the past. And that's pretty much across, some of the stocks that you highlighted. Asian Paints, anyway, I discussed. Bajaj Finance, similar issues. Obviously, see, as the loan book becomes bigger and bigger, the growth rates have to come down, right? But it's still growing very fast. 25% is no joke with that kind of base it is sitting on. But yeah, I mean, it just,
Right.
the middle point over here is the multiples have to be lower compared to whatever given in the past, simply because of growth rates will probably be lower for most companies and uh, and sectors. I mean, most companies in the sense, the growth for the sector will be fine, but it could probably get split across more number of players, and profitability slash returns
Right.
will be lower, I think, going forward. For new sectors, that's a different story, but
Right.
for the,
So,
you know, traditional sectors with, let's say moderate growth rates, it's hard to justify, why one or two players will stand out, and will have very high, let's say, multiples compared to rest of the sector.
understood. So in the blue chips, are there companies that you are bullish on? I see some in your report, but please tell me.
I mean, we still like the banks, obviously many of them are deteriorated quite significantly. Um, if you look at something like HDFC Bank itself, and we talked about, now it's come down to 2 times price to book, which is a very decent valuation, I would say. And Axis Bank is down to 1.6, IndusInd is down to 1. SBI is also about 1.1, 1.2 if you take out the value of the non-bank businesses. So there are enough number of financials at least which look quite okay. And we are even positive Bajaj Finance
Yeah.
current levels. So there are a number of ideas, at least in the financial space. I mean, there the concern now seems to be more to do with the fact that asset quality in parts of the loan book has worsened in the September and expected to worsen further in December quarter. Some amount of, I would say, spottiness emerging in parts of the lending book, other than the MFI book, which obviously we have seen challenges in September quarter itself. So the concern among the investment community for now is whether the challenges that you are seeing in MFI book, which is more specific to the small finance banks and the loan books of some of the banks with exposure to MFI segment, whether that pain will spread across to more parts of the lending, namely the personal and secured loans,
That's
MSME
right.
sector, and so on and so forth. I mean, as of now, we are seeing some signs of it, but not something that I would be very, very worried about. The banking sector response is pretty typical. You will probably see some slowdown in loan growth with more focus on collections and repayments over the next 1 or 2 quarters till this situation, tides over. Lastly, on the MFI issue, keep in mind the fact that it's not as if the repayment capacity of or the financial condition, let's put it way, of the borrower has got impaired significantly. It's just that, in a way, you have been forced to reduce exposure to a section of borrowers who had more than 4 relationship with, let's say, 4 or 5 different lenders. And of course, if you ask a borrower to suddenly repay 20-25% of the loan book, he or she may not be in a position to do so. That portion of the loan book will become um, NPL or slippage, whichever you want to call it. But it's not as if the financial condition of the borrower has, deteriorated significantly. Not like a COVID-19 situation where the income just collapsed. I don't think we are in that far from it, I would say. Beyond that, I mean, we're still okay with some
Okay.
of the pharma names. For example, a supply trading at 24p, very strong business, both in the domestic pharma side and in the US generic part. So looks quite okay, I would say, at current levels. Lupin also looks fine at about 28p. So there are, here and there you can find some, names, but broadly speaking, it's a challenge, to find a value in this market.
Fair enough. So I wanted to ask you one more question relating to financials. Do you see any growth challenges? Because one of the points about banks is that, if private sector capex is not going to go up in a big way, which, you see that happening in pockets, but it's not that the traditional industries and companies are really borrowing a lot. And that's also got to do with the fact that, companies themselves are generating so much cash, and there doesn't seem to be great level of confidence in deploying that, putting that cash to work. Do you see growth as a challenge for banks, and will that sort of, expect that to go away this year?
It will take time for animal spirits in the private sector to come back. If you look at the breakup of or the loan mix of the banking sector, industry is roughly 21-22% of the total loan book. Yeah, but in that, if I remember correctly, is going about 6-7%. That's about it. Yeah, so that itself is a big drag on the overall loan growth of the banking sector for all the reasons you highlighted. The balance sheets of at least the big companies are in very good shape. They are going slow in investment for whatever reasons. So obviously that has a bearing on the overall loan growth of the banking sector. Then you come to the retail part, which is roughly 1/3 of the total loan book. There, I think the banks themselves may want to go slow till the time there is more visibility on how this whole NPL situation is evolving. So yeah, so I suppose we are looking at 10, 11, 12% kind of loan growth for the banking system as a whole at least for the next few quarters. After that, we'll see, based on, hopefully, some revival of animal spirits in the private sector. Hopefully next 2-3 quarters, we are past this small NPL cycle, hopefully, within quotes, that we are seeing as of now. And then hopefully we're back to the races.
One last question, Sanjeev. How do you see this Trump trade playing out? You point to several contradictions in your report. How do you see the bond yields going forward? Do you think the strength of the dollar will continue in the short term? What's your take?
Recently, starting from late October, when the market started getting onto this Trump trade, it was a very nice, expectation which had got built in that you will have, a combination of decent growth in the US economy, corporate tax cut, which will lead to higher earnings growth for US corporate sector, some amount of income tax related cut also, which would be good for, again, demand and, the corporate earnings, and no worries about the negatives from this, these set of assumptions. Yeah. So the market had quickly latched onto the positives or the perceived positives from any potential changes on the taxation side, etc. Yeah. Now, on the negative side, sort of investors didn't care about too much was the fact that if the Trump administration was to go and impose higher tariffs, which it is threatening to do across products from various countries, then it's going to be inflationary for the US for sure. It may help definitely in getting additional revenues, but it's going to be inflationary, and which is what the market now started to get a bit concerned about. Which is the reason why bond yields are higher and so on and so forth. And there's another big reason which I'll come to. The second thing which the market conveniently ignored was the fact that if you are going to see corporate tax cut, income tax cut, which is all good for corporate earnings, but it also means that you will see a big drop in US tax revenues, leading to higher fiscal deficit. Anyway, US earning 6% plus fiscal deficit, which is unheard of in its history, which means, the bond investors would ideally like to see much higher, yields or repayment or interest for the additional worries coming from much higher fiscal deficit, and which is exactly how the bond market has reacted. At least, bond yields have gone up sharply, 100 basis points in the last 3-4 months, and which is where now the market is suddenly getting worries or jitters about. The US Fed has made it very clear that not going to be cutting rates in a big hurry. Now the expectations are down to 1.5, rate cuts of 25 basis point each compared to 4-5 rate cuts in 2025 earlier. And bond yields are, where they are. So that seems to be singing a very different tune compared to the equity market, I would say. The bond market is, clearly getting worried about inflation and long-term, fiscal deficit and repayment. I would say capability of the US is, of course, will manage. But yeah, I mean, there's definitely a lot more concern building in the bond market compared to the equity market for sure.
Sure. And what do you think, how do you think foreign investors will react to this whole thing? I mean, we've been talking about, since November, there has been talk that, this is the end of foreign selling. The peak of foreign selling is perhaps over, but it just continues unabated.
There's no reason why foreign investors should be coming back to India in a big hurry, to be honest with you. If you look at last year, for example, the 2024 calendar year, it was about $0.8 billion negative from foreign FPIs. Yeah, it may not look like a very big number, but if you break it down between the primary and secondary part, primary was $14.4 billion positive, secondary was $15.2 billion negative. Yeah, and that is a bigger, indication of the way they are thinking about the Indian market. Clearly do not like the valuations over there. Interestingly, even in that 15.2 billion negative number of FPI secondary sales, it seems that about $13 billion or so of passive positive inflow. That's from the ETFs. Yeah. So if you take that aside or remove it from the 13, the actual selling from FPIs in the secondary market, that is active FPI in the secondary market, would be closer to $28 billion. I think that's a far bigger indicator of how the FPIs are looking at India. It all started with, anyway, they were very convinced about the valuation through the year. They had been selling only, except for June, July, and September, where you saw decent amount of money coming in. From October, late September, early October, first of all, you had the pivot towards China because of all the favorable announcements made by the Chinese government on monetary side, fiscal side, etc. And then since October, anyway, this whole US Trump trade started, So as of now, we are in a situation where the US asset allocators, US investors still build up on, or very build up on the US market. US dollar doing wonderfully well. So why would an asset allocator sitting in the US want to look at emerging market country? Yeah. So that's one.
Right.
Number two is you look at emerging markets as an asset class. It's been a disaster. There's no other word to use over here. Last 10 years, cumulative dollar return, MSCI Emerging Market Index, 8%. That is it. Not 8% CAGR, 8% cumulative return.
Right. Correct.
Against that, US S&P Index is up 3x. NASDAQ is up 4x, by the way, in the last 10 years.
Yeah.
So why would an asset allocator bother about EM? Yeah? So I don't think you should be expecting any new money coming into emerging markets. And on top of that, you have rising tension between China and the US. China, the big part of emerging market. South Korea, what all has happened over there. If emerging markets keep on doing this kind of things, I mean, why would anybody want to come in the emerging market in the first place, right? So India is doing the right thing, but it's colored by this whole emerging market, issue. And then there's a specific India challenge of very high valuations. At least that's how then the foreign investors are looking at it. So I think foreign inflows, I don't think is coming for a while. Anyway, now people would want to see over the next 2-3 months, how this whole US situation is evolves in terms of, the domestic policies, foreign policies, immigration, healthcare. There's so many things, out there. And then only, asset allocators / investors will take a call in emerging markets / India.
Sure. So you expect this year to be a down year, 2025?
Oh no, yeah, I think, maybe the large cap index would still hold up. We could hopefully see some positive return also. 1 year is a long time, and I'm not in the business of forecasting stock prices, to be honest with you. But be very careful of the small, the mid cap, small caps, narrative names we discussed. They have a long way to fall based on the fundamental fair value of the companies. I'm not making clear that they will fall. Again, I'm not in the business of forecasting stock prices, but if I, look at the current price of this company versus what I think is the fair value of this company, there is a huge gap to the downside, that is, So, and that's what investors should be very, very, very off. Whether it will happen or not happen, then God only knows, to be honest with you.
Sure, sure. Thank you so much, Sanjeev. It's always such a pleasure talking to you. Thank you so much.
Sure. My pleasure entirely. Thank you. Take care. Bye.